China is full of mini cycles, and we've seen that over the past decade where regulation is not new. And one needs to understand where government policy is really focused. So from an investment perspective, we look at 2011, 2013, 2018 and 2021, during all those periods, PE multiples and stock prices fell. And notwithstanding the current year, in all those prior periods, Chinese related equities bounced back on average 15% in the following year. So where are we buying? We're focused on areas where the government is aligned. Longtime China watchers will know that leading into the financial crisis, banks were the hot areas. The following decade related to tech. Now it's the green economy, which we've heard from your colleague, and it's areas like health and wellness. So we're buying companies that are plugged into that government policy. In particular, companies like Baidu, global leader in AI, is going to help accelerate the EV transition. And then health and wellness companies like Anta, as China focuses more on improving the health of its citizens.
Seems like there is still a lot to buy in China. Arthur, why are you being bearish then? Because what goes down must come back up. So there's a price for everything. And it's not like this regulatory issue has taken away the intrinsic value of these businesses. Yeah, I mean, there's been a readjustment to the downside, but these businesses will continue to grow. So why is it that you're staying away?
So I believe the key point, in my opinion, is that valuations are not cheap on index level. We look at index level, we don't look at individual companies. And if we look at index level, valuations are not cheap. In fact, it's very important to differentiate two segments of Chinese market. First, it's internet new economy stocks. These are platform companies. They have been under regulatory pressures. They still trade at very high multiples. MSCI Growth Index trailing P ratio is 34. 34 on average for that index is still very high. And second part is the old economy in China, which seems to be cheap. Multiples are very low, but old economy in China is still slowing and will continue slowing in the months ahead. And what we're witnessing with property market will just reinforce that slowdown in old economy in China. So old economy stocks, even though they look cheap, the profit will be hit and they don't look attractive for next several months.
Thanks, Arthur. Then, Jack, can I ask you to respond to that? Does that then fall in with your theory that some investors are just putting China in the too hard basket?
We think that's right. I mean, it's been well flagged that there's been $1 trillion of market capitalization wiped off US ADRs. And secondly, we know things like iron ore imports are down 20% year on year on a rolling 3-month average. We know the iron ore price has been under pressure. I don't think this softness comes as a great concern when you're also seeing the Twitter universe speak of Evergrande most minutes of the day. So there is weakness. There's no doubt about that. We've seen this many times before in the country. And one of the differences that we believe is happening in China is that the government is just realigning its focus as opposed to thinking the wheels are falling off. So we actually view that as an opportunity to re-engage at a time when others are panicking. And that's what we've done. And we've been acquiring assets on behalf of our investors in recent weeks.